segment because we're talking about helping others and doing well while also doing good for yourself. Planned giving has been increasing dramatically in the United States in the last couple of years, even though overall people in some cases have seen some hardship post-COVID. But in 2021, despite that, corporate giving was up about 23% compared to 2020, and foundation giving was up about 3%. Now, as has been the case in the past, most of the giving has been coming from individuals, which represents about 67%. You may have noticed in Cleveland, a $20 million donation just came in from the ex-wife of Jeff Bezos. So we're also seeing some larger local types of donations coming in. I think part of it is people are feeling a little bit more confident about their financial positions individually. Of course, when we're talking about the big Bill and Melinda Gates Foundation, McKinsey, we talk about the Buffetts and the Giving Pledge. They're not really affected by any of that. But on an individual level, we're definitely seeing more. And it's something you may run into in your practices, especially as we talk about estate planning and asset protection, which we're going to touch on tomorrow. The other reason, and the doing good for ourselves, is to minimize tax. By gifting a highly appreciated assets today, you can avoid the capital gains tax and potentially take a tax deduction, which is what we're going to look at. It's also something people will be looking at to reduce their estate tax, and we'll talk about that tomorrow as well. But right now, the estate limit is about $25 million for a couple and about $12.5 million for an individual before you pay any estate tax. That's going to sunset, and starting in 2026, the number goes down to about $5 million per individual. And the Biden administration has recently proposed taking it all the way down to $3.5 million. So we may have a lot of people who would not have been paying estate tax under today's limits that will be exposed in a couple years. And so whether it's transferring assets or gifting may be something to look at. And we will get into that a little bit more tomorrow. 85% of U.S. households do give to charity, and actually 95% of families who have a net worth in excess of $1 million, and about 98% of families who have more than $5 million. So it's not an uncommon thing. And again, in your practice, and maybe personally, it's something you may run into, which is why we're discussing it today. And again, all these numbers we'll have in our handout materials. Now, one of the questions we get is about the charitable deduction, and did it go away or what's changed? In 2022, the standard deduction was $12,950 for individuals. So before you itemized, you could take $12,950 or about $25,900 for couples. So a lot of people that were donating couldn't deduct the donation because their standard deduction was higher than the amount they were donating. Now, if you don't claim an itemized deduction for a charitable gift, you can carry it forward up to 5 years. And we'll look at that in a second. Back in 2018, one of the things that happened was the qualified charitable distribution. And this allows people that are taking required minimum distributions from their IRAs to give money directly to a 501c3 and avoid any tax. Now, it's interesting because the RMD age is now 72. However, you can still do a QCD if you're over 70 and a half. So if you have clients, or perhaps you are taking distributions from an IRA and you don't need the cash, and you're already making charitable donations, This may be a better way to do it because effectively you're going to avoid the tax, whereas your charitable donation may not be deductible. The only two caveats here. One, there's a $100,000 annual limit, so the most you can do is $100,000. And two, you cannot do this to your own donor-advised fund. It does have to go to a 501c3 as far as that goes. Again, charitable contributions are deductible for donors who itemize, but if you don't itemize, you may be able to carry it forward. The limits have not changed. So basically, you can take up to 30% of adjusted gross income for contributions that are in kind, so stocks, etc., or 60% for cash. So if you make $100,000 a year, you could write off up to $30,000 of appreciated assets, or $60,000 if you did cash. And of course, the nice thing is if you make an in-kind distribution, you can avoid the capital gains and still get the deduction. So in other words, if you paid $1,000 for something and now it's worth $10,000, if you were to sell it, you would owe a capital gains tax on the $9,000 that you made. However, if you donate it, you avoid that capital gain and you get a tax deduction for $10,000. And again, as we said before, contribution amounts in excess of what's deductible can be carried up to 5 years. Now, there's really 5 levels of giving that we're going to touch base on. We've already been talking about outright gifts. We'll also talk about life insurance, charitable remainder trusts, charitable lead trusts, and then donor advised funds and private foundations. Now, the most popular thing are outright gifts. Typically, they're made currently, although sometimes they're on a testamentary basis where they're based or outlined in a will or a trust. If somebody is making a cash gift, the check has to be mailed by December 31st. And really, if you're getting into this time of year, where we're close to year end, I would send it certified or via UPS so you have a proof of the mailing and then you can track it. If you're donating in kind, you should get statements from the investment firms involved, but keep in mind that could take a couple weeks to happen. I think a key question, though, is what the motivation is. Are you a philanthropist? If the motivation is simply tax deduction, there may be other things to do. It may not make sense to be doing this. If there's a mixed goal, which would be, hey, I want to help others, I have a philanthropic intent, but also if I can help myself, that'd be great, then I think this makes sense. As with anything, there are some I's to dot, T's to cross. If you're making non-cash distributions and it's more than $500, you do have to file an IRS Form 8283. If you're making those types of donations, it's important to let your CPA know because generally there's no reporting from an investment firm. There's no 1099 per se for any gifts or donations. So you need to let them know and keep a pretty good record as far as that goes. Also, if you're claiming a large deduction, we've had a number of clients donate buildings and so forth. If it's over $500,000, then you need to attach a qualified appraisal to your tax return. So it's very important before making that donation or that gift that you get that appraisal because often they won't do it after the fact and obviously be ashamed to make the donation and then not be able to write it off. There are also some special rules for certain types of properties like automobiles, inventory, that type of thing. Again, your CPA should be able to help you with that. If you're really curious, it's IRS publication 526 that you can look at. You can also look at Pub 561, but our recommendation is to work with a qualified CPA. Makes your life a lot easier. And with all the changes that are constantly happening, they can stay on top of this as far as that goes. We had mentioned the QCD, Qualified Charitable Distribution. The Congress did make this permanent, which is nice. And this really is a great way to fulfill giving pledges, etc. Because while you don't get to deduct it twice, you are going to get the write-off, you're going to avoid the tax on the money coming out of your IRA that otherwise would be taxable. The next level of giving is life insurance, and there's two sides to this. On the one hand, we have a number of people that will donate assets and then purchase an insurance policy to make up that asset for their heirs. Typically, it's called an irrevocable life insurance trust, or an ILIT. The policy is placed in the trust, and then upon passing, the beneficiaries get the money, both income and estate tax free. Because it's in an irrevocable trust, there's no estate tax, and because it's life insurance, there's no income tax. This can be a great way to leverage assets that are really meant to go to your heirs. So on a guaranteed basis, you get some really good leverage, and then as far as the tax advantages, they're very, very significant. But the key is to place that policy in an irrevocable trust so that it does avoid the estate tax. There's no point buying a $2, $3, $4, $5 million policy and then having to pay tax. The second side to this would be the opposite, where somebody has an existing policy that they really don't need, or it's relatively small, in which case they would name the charity as a beneficiary to that policy. And we see more people do that, either naming the entire policy for the charity or the nonprofit, or a portion of it. So perhaps you have a policy that's larger and you want to put a portion of that to the charity. And again, I should mention, if anybody has any questions, we're going through a lot of material fairly quickly. There's a chat box. Just type it in the chat, and we'd be happy to answer the questions as they come up. And of course, we're happy to chat later. Clearly, each person's situation's unique, and there are a lot of pieces to this. So we're happy to sit down. Any of our team can discuss this on a case-by-case basis. The third level of giving are charitable remainder trusts. These were very popular a number of years ago, and then as markets fell and net worths fell, and frankly, as the unified credit went up, people moved away somewhat. This is a way to make a larger charitable gift in the future, but to retain interest currently and potentially to get income. So in the case of a charitable remainder trust, you're simply setting up an irrevocable trust, and into which you're putting property or cash. These same deduction limits apply. The trust is just like any other 501c3, so 30% on in-kind donations or 60% on cash. Now, one of the things we've seen people do, which works very, very, very well, is if you have private stock and it has a low basis or low valuation, and you intend on selling the company down the road, but there's no intent today, placing that stock in the charitable trust can avoid all of the capital gains when it does appreciate. Now, it's very important to note, you cannot do this in anticipation of a sale. The IRS is going to look at that. So if you're already contemplating a sale and you've reached out to potential buyers, or there's correspondence or documentation, and as you just heard in the previous presentation, it's discoverable, then you cannot do this. However, if you've not started pursuing that, putting very low basis or no basis stock in your own company or in an investment into this can reap some significant benefits, because as things are bought or sold in the trust, there is no tax. It's just like a charity. You retain control as the trustee, so you can buy, sell, and transact business within the trust. You can also take money out. Now, the IRS does have some guidelines on how much can come out. There has to be a reasonable expectation there's money on the other end for the charity. But a lot of times what people will do is set this up and view it as a future source of income in retirement with what's called a NIMCRUT, NIMCRUT, stands for Net Income Makeup Child Remainder Unit Trust. Monies that you'd be entitled to take out each year continue to aggregate and carry forward. So if your trust says you could take the greater of or the lesser of all income or 5% a year, and you don't take the 5% this year, you could carry that forward pretty much indefinitely. And then down the road, either take a lump sum or start taking annual distributions. Typically, the way the trusts are set up is they're worded that you could take the lesser of a fixed percentage or all income generated. And then the trust is invested in a manner that it does not generate income in years that you don't want to take money out. So for example, we might use annuities or other types of deferred vehicles within the trust. When income is desired, if it's desired, then we'd readjust the trust. So it's important not just to work with an attorney familiar with how to set this up, because it is irrevocable, but also with a financial team that's familiar with this, and frankly also with your accounting team to make sure not only that you're taking advantage of everything that's available, but also you're not doing anything that might disallow the trust itself. So the asset would go in, you do get an immediate tax deduction, and then if you take income coming out of the trust would be taxable to you as ordinary income. Upon your death, or perhaps your spouse's death, or down the road, whatever's remaining in the trust would then pass on to the charity. And essentially you could stretch this out literally 21 years past the death of the youngest living beneficiary. And as we said, it's important to work with an attorney familiar with this. There are rules against having money in perpetuity. And of course, the longer you stretch the trust, the less the deductions may be based on the IRS formula. But that being said, essentially you would put assets in, they would grow, they would be managed. At some point, you or your children or your grandchildren could derive income from the trust, and then upon your death, the money would go to the charity. Now, one of the things that's done with this is putting in assets to reduce an estate, and then also buying the irrevocable life insurance trust we just spoke about to make it up. So hypothetically, let's say a client had $10 million in assets that would be exposed to estate tax if they, when they pass away. So their heirs effectively might get roughly half or $5 million. Instead, they put the $10 million into a charitable remainder trust. They could take income. They have a $10 million tax deduction today, and the charity's going to get probably about $10 million. At the same time, they buy a $10 million life insurance policy, and they use the income from the trust to pay for the policy. That policy is not part of the estate. It passes income and estate tax-free to the heirs because it's in an irrevocable trust. And by doing this, the heirs basically get double the money, in this case 10 million versus 5, and the charity gets 10 million. So it's truly a win-win for everybody. And basically linking that irrevocable life insurance trust to charitable trust is something that's been done for decades. As far as the life insurance side, generally what's used is called a second to die, or the more politically correct term, a survivorship policy, which is on 2 lives, and it pays upon the second death. Because of that, even if one person is not super healthy, we can often still get the policy. And again, you don't have to be younger. We've written these up to age 75, 76 for people, so we can look at that. Obviously, it is subject to underwriting, but the guidelines are fairly reasonable at this point in terms of that. The next thing we're going to be talking about in a second is the opposite side, which is a charitable lead trust. Now, the charitable remainder trust, the donor receives income during their lifetime. When they pass, the money goes to the charity. A charitable lead trust is the opposite. The donor puts assets in, and the charity starts getting income immediately, and then after a period of time, typically 5 to 10 years, the assets pass back to the family. If this is done prior to death, then the assets are excluded from the estate. And effectively, you can transfer money to your family and avoid the estate tax entirely. Keeping in mind, it's irrevocable. The assets are tied up for the period of time you've designated. But again, you're benefiting the charity, and you are able to transfer funds as far as that goes. The tax deduction is a little trickier, and that's something that we'd recommend speaking with your CPA about, because there are some nuances to that. The other way that we do see people setting these up is what's called a TCLAT, or a testamentary charitable lead trust. And this is a very interesting thing, because one of the issues with estate planning is often that to avoid state tax, you have to make irrevocable decisions and give up control of the asset. With a TCLAT, you can make the decision to fund it upon the first death. Husband and wife, the husband dies first because that's usually the case. The wife can decide if she wants to fund the charitable lead trust, in which case those assets would not be part of her estate, or if she doesn't. And of course, there's no estate tax between a husband and wife, so there's no downside necessarily to doing that unless both of them die at the same time. And again, perhaps the easiest way to think of a charitable lead trust is the opposite of a charitable remainder trust. The income is going to go to the charity during your lifetime, or it could be for a period of time, 10 years, 20 years, and then ultimately the assets get transferred to your heirs. This can also be used to transfer money further down the road to future generations, such as grandchildren. Assets in any of these trusts, because they're irrevocable, they are protected from creditors. So that's another potential benefit that we have people thinking about when they're looking at setting them up. The charitable lead trust, again, because of the complexity and the fact that it's irrevocable, we do recommend working with an attorney that's familiar with these. If you have a case and it's something you don't deal with personally, we can connect you with someone and you can work out how you want to coordinate with your client on that. But it's a very interesting tool. And again, we're seeing more use of this as people don't want to permanently give up assets but would like to benefit the charity, perhaps immediately. The next thing that we're going to touch on are donor advised funds and private foundations. Private foundations, for most people, quite frankly, just don't make sense. They're expensive to set up. You have a lot of expense annually with the accounting. They must distribute 5% per year. And really, in our minds, if you have less than $1 million and more likely 5 or 6, it really does not make sense to do the private foundation. Some of the advantages we'll talk about in a second, as far as that goes. Now, a donor advised fund really is kind of like a private foundation in that once you put the money in or the assets, you get a deduction up front, and then you can direct grants to charities that you choose. In the case of a donor advised fund, you cannot be compensated, whereas with a family foundation you can, but the minimums are significantly less as far as that goes. So let's take a quick look. So in a donor advised fund, effectively the trustee, which would be a trust company, is making the donation, but as the name implies, they're advised by the donor. So practically speaking, you would say, I want to make a grant to this person or this organization, and then the trustee would do it, assuming it's a qualified nonprofit. This is something to consider, as some trustees are more restrictive on the charities they'll recognize. In the case of Raymond James, it's pretty much any 501c3, but others may be more restrictive as far as what they'll allow. So it's very important to understand that before working with them. One of the nice things is you can name this anything you want. It can be the XYZ Giving Fund. We've seen some very creative and interesting names on these things, but it can be called whatever you want. Probably the biggest thing is it's very simple. It takes about 5 minutes to set up. There's no legal work involved. There's no accountant. There's no cost. We simply need to know pretty much the name of the donor advised fund and who will be the advisor on this. Very easy access. You can see the information, very low cost that we'll talk about in a minute. And you get an immediate tax deduction for assets given. So we talked about earlier that because the standard deduction has moved up to about $13,000, $26,000 per family, a lot of people's donations are not deductible. Well, one of the things people are now doing is bundling donations. So they might say, we want to give $5,000 a year, but that's not going to be deductible. So we'll put $50,000 of appreciated assets in the donor advised fund, get the deduction, and then we can make donations as we wish going forward. So by bundling several years worth, this can work well. The donor advised fund, much like the charitable remainder trust, you can put appreciated assets in there. And one of the nice things about that is you avoid the capital gains tax, and you do get an immediate deduction. You can donate cash or in kind. Something else that's important is building a family legacy. And what we've seen is a lot of times families will get their kids involved and basically have a family meeting to say, who do we want to give to this year? What's important to us as a family? It's an interesting way to bring, the family together to have a discussion. And then upon their passing, it can be a tradition that the kids kind of continue. The other thing is it's very simple to change as your interests change or um, you have new charities. Literally, it's as quick as an email. Say we'd like to take off Joe's charity and put on Jane's. And we can update it as much as somebody wants. You can name as many as you want. Now, you can put these things on autopilot where you say, every year, distribute 5% of the trust to X, Y, and Z, or you can direct it yourself on an ad hoc basis. There is no requirement to distribute funds from the donor advised fund, unlike the charitable foundation. The other thing is there is some, as we said, the tax treatment is pretty much the same as the foundation. You can use it to remain anonymous if anonymity is important to you. And again, you can do a number of charities if you choose to do so. We've also seen people do several donor advised funds with different names. Now, this can terminate upon your death. So the thing could say, upon my death, all assets contributed to, say, the Girl Scouts. Or you could say, upon my death, the fund will distribute 5% a year in perpetuity to these charities. Now, one of the nice things about a donor advised fund is you do have the trust company. So whereas in the past, we had people name charities directly on their IRAs and retirement plans. The issue can be if the charity doesn't exist upon your passing, then somebody, usually the courts, have to figure out what to do with that. In the case of the donor advised fund, the nice thing is the trust company will find a like charity for you. We had a case of somebody that left money to the San Jose, Texas Opera. Upon their passing, San Jose, Texas no longer had an opera company. And so the trust company went out and found an opera company in a small Texas city, I believe it was Austin, to fulfill their wishes. But there was a mechanism for doing that. So the donor advised fund is a great alternative, in our opinion, to naming charities directly as beneficiaries, even in a will or a trust, because if you do name a number of charities in your trust, every time you make a change, then you have to update the trust, which can be time consuming and expensive. Donor advised fund, it's simply a matter of sending an email or reaching out to the financial organization. If it's us, just letting us know what's happening. The minimum investment, $10,000, so very accessible. The minimum additional contribution, $500. So again, very, very nominal. The minimum annual fee is $125 that in our case, Raymond James would charge. It's typically a percentage of assets that they're charging. So if somebody put in $10,000, the fee be $125, but typically the fee's around 1% a year. And for that, they take care of all the record keeping, the reporting, the distributions, statements, etc. So it's a pretty cost effective way to manage the asset, and it's very simple and easy as far as that goes. Now on the other side are the private foundations. These do give the maximum amount of control and flexibility because again, they can make grants or they can conduct charitable activities themselves. Typically they're set up as either a trust or a nonprofit corporation. As with all of these things, there's immediate tax deduction. However, they must distribute 5% a year. So while the investments can grow, they do have to distribute money each year. The board can consist of family members, and one thing that is different is they can be compensated. So we've seen this as a way for wealthier families to generate income to their kids or other family members. They put them on the board and then pay them a salary. It should be noted, of course, that has to be reasonable. All of this can have to pass IRS scrutiny, but the charitable purposes can be very broad based on your own bylaws. One thing is, as you draft this, and this more so even than the charitable trust, you want to be careful to draft it to meet whatever your values are, so you don't violate your own bylaws. But working with in this case, both a law firm and an accounting firm, and most likely an actuary, is going to be needed. We see the fees to operate these things at a minimum of $10,000 to $20,000 a year typically, and usually it's more than that. So again, in our opinion, a very, very bare minimum would be $1 million contribution, but typically more like 5 million, where this starts to make sense versus the donor advised or some of the other types of things that are available. So if we look at the two, the structure, the private foundation is set up as a trust corporate entity. Donor advised fund's just a written agreement with the trust company, essentially. Significant legal and accounting fees for the private foundation, both on the front end and then annually. Donor advised fund, again, depending on the organization, could be as little as nothing, and it could go up from there. Costs to run it, again, a lot of annual legal, accounting, administrative expense, plus if you're paying salaries to anybody to be on the board. As far as the donor advised, it's typically as little as 0.25% up to maybe 2% a year at the high end. Again, in this case, we're saying a minimum donation of $1 million, but typically the recommendation is 3 to 5, whereas the donor advised, it's just $10,000 typically. The one thing that's interesting is the deduction on donor advised may be slightly higher than on a private foundation. The numbers continue to be refined, and in 2023 they're going to be updated. Now, as far as the tax exempt status, again with the private foundation, you've got to file your application and then do all the annual reporting. With the donor advised, there's nothing that you really need to do. With the grants, minimum 5%. Generally donor advised, at least in the case of Raymond James, there's nothing that has to come out. And then taxes, there may be taxes on the private foundation, 2% of net gains, including capital gains. There are no taxes on the donor advised. So again, the private foundation may not be able to grow as much. And it's kind of interesting that we're now seeing large donor advised funds. Whereas in the past, they were typically, smaller donors. We're now seeing donor advised funds in the several $1 million range that we've set up. Whereas, in the past, that would all be kind of private foundation money that's out there. Now, I think there's a lot of, obviously, opportunities. There's also a lot of challenges as we're moving forward. As we go into 2023, and we'll be talking more tomorrow about the outlook for the markets and some of the changes. We've also got a speaker that's going to be touching on the impact of the election and some of the things that are happening. I think, this is an area that's evolving, and it's a little bit more complex. You've got the tax aspects, and charitable is one of those things that politically is a little harder to attack, but at the same time, the rules are always evolving, and some of these things, for the better or for the worse, like the qualified charitable distributions, which came out a couple years ago. I think at the end of the day, the first thing is you have to decide, are you philanthropically motivated, or is this more to develop a strategy for estate planning or income tax reduction, etc.? Once you know what that motivation is, the first thing is to look at the causes that are important to you. You know, what causes are important, whether it's specific organizations or broader based types of things. Especially if it's broader based objectives, the donor advised is interesting because, as we said, if a specific organization doesn't exist, then the trustee in the future can find something that does. And especially if you're setting these things up, for 20, 30, 40, 50 years, a lot can change. If you think over the last 50 years, the nonprofits that have come and gone, it's almost endless. And there's over 1 million nonprofits in the United States today. So certainly a lot. The second question I think that's very interesting is, what do you want to accomplish through the giving? In other words, if you say my focus is on homelessness, for example, is your goal to reduce homelessness? Is your goal to help organizations that help the homeless? Is your goal to help people directly? What is it that you're trying to accomplish? Because those two questions will partially dictate what you're doing. Are you giving money directly? Are you giving money in the future? Etc. The next thing is, how involved do you want to be? In the case of a donor advised fund, there's nothing you really have to do once it's set up. Obviously, in the case of leaving money via a life insurance policy or an annuity, again, once you name them, there's no involvement. If we're making contributions directly today, do you want to put conditions on them? For example, the funds cannot be used for administrative expense, but they must be used for the intent of the charity. We see people, for example, give to the food bank, and it says this can't be used for overhead, this should be used for food. The next thing is, do the organizations reflect your values? There's a lot of research that can be done with Trustpilot and online to dig into the organizations. And something we're seeing a lot of clients be very interested in is how efficient organizations are with the funds. If the CEO of the organization is making a huge salary and only 20% of the donations actually go to the cause and 80% go to the CEO, that may not be something you want to be involved in. And so it's very easy to see how efficient organizations are and to see where the funds are going. So I think that's something to be aware of. Think about the legacy you want to leave as far as the name on it. Think about how involved you want family members. And finally, do family members need income? In which case, if you think kids or grandkids might need income from this, then looking at the charitable remainder trust or some of the other things may make some sense as far as that goes. So let's talk a little bit in the time remaining about some giving strategies for the rest of the year that's coming up, and really the rest of this year. Obviously, one of the most effective things is, and which can have some of the most impact, is simply to give highly appreciated assets, non-cash assets that you've held for more than 1 year. This can mean giving them directly to a charity. Some charities will accept them, some won't. It's interesting, I've had people say, well, they're not going to take my stock, I'm not going to deal with them. Or again, putting them through a donor advised fund or a charitable remainder trust. It's almost too late to do a charitable remainder trust for 2022, just given the time left in the year and what's involved in setting it up. But there is certainly time to do a donor advised fund between now and the end of the year, because as we said, it takes just minutes to set those things up. One thing that we have seen people doing as well, which I should mention, is getting money out of their charitable remainder trusts and putting it into a donor advised fund. That could be a non-taxable transaction because the income is offset by the donation, and it can give a little more flexibility. Plus, it's just less expense as far as that goes. But really, donating appreciated assets is probably the number one thing to do. And then thinking about how and where you want to donate them. As we said, bunching donations, we talked about this before, that some donors may estimate that their itemized stuff's less than the standard deductions. And so it could be beneficial to kind of bunch your 2022, 2023, and maybe future donations together so that you make a larger donation to the donor advised fund or the charitable trust in one shot, and then you could do your annual gifting in the future. Obviously, if you give the money directly to the organization, then you don't have the ability to do stuff in the future with those particular funds as far as that goes. And then finally, something that's very, very interesting, and we've started to see more of this, is donating privately held business interests or real estate. And these may have appreciated significantly, especially businesses where people started them with nothing and they have value. But also, just like with publicly traded securities, you can eliminate capital gains and claim a deduction by putting these things into either a donor advised fund or a charitable remainder trust. Now, donor advised funds may have experienced facilitating contributions of real estate, which we do. Privately held businesses can be a little bit trickier, especially if they're not being liquidated. And as we said, to get a deduction and for the donation to your own charitable remainder trust, it cannot be in anticipation of a sale. So if you've already spoken to people, you're looking at selling, or you have correspondence saying, I'm getting valuations because I'm thinking of liquidating the business, then that isn't going to work. You can't do that. But if you don't have a specific intent today, but you think, hey, in the future, I'm going to liquidate my business, then putting shares into the either a donor advised fund if they'll accept them, or into a charitable remainder trust can make sense. And keep in mind, the charitable remainder trust can pay out to your kids and grandkids, or what may be more efficient, as we discussed a few minutes ago, is to simply purchase a life insurance policy equal in value or greater and have that go to them. And therefore, again, you avoid the estate and the income tax as far as all of that goes. And then lastly, take a look at required distributions. Even if you're not taking required distributions at 72, if someone's over 70 and a half, and they do have some philanthropic intent, they can give up to $100,000 a year from their IRA. The amount of the qualified charitable distribution can exceed the required amount, so you can give more. You just can't give more than $100,000 per year. If the required amount is over the $100,000, then obviously the person's going to have to take a distribution from the IRA to meet that amount going forward. I think, as with anything, and we talked about this, it's good to have a plan looking beyond just this year. Consider going out, and especially given the potential sunset of the estate tax in 2026. And again, we're going to get into this more tomorrow. But while the unified credit today for an individual is about $12,500,000, the Biden administration's proposed taking it all the way down to $3.5 million. And that would expose a lot of people to estate tax. As it stands today, if nothing changes, the amount sunsets back to about $6 million in 2026. So people have over $6 million individually or $12 million together. They will be subject to estate tax, and that could be 50, 55, 60%, depending where we're at. So getting assets into some of these vehicles now can reduce the estate while at the same time increasing the net amount that goes to your heirs and helping the charities. So as far as 2022 goes, we're kind of getting to the end of the year, but there's still a little bit of time as far as that goes. Everybody's situation's different. Feel free to reach out to us. Obviously, speak to your CPA as part of it and come up with a plan. So it's a great time, as we said, to do well while also doing good for some charities. So we thank you for joining us today and joining us for the CLE, and we'll be back in a few minutes.